Hello everyone, I'm Sahil and welcome back to my channel. If you still do not know who I am and what this channel is all about, I would highly recommend that you go check out the first introductory video, the episode 1. I will post it somewhere on the screen. In this video, however, I'm going to give you a crash course on accounting like the title suggests. I just felt that it is important that we go through this so that it's easier for everybody to understand when I share my personal financial position and how I keep track of it. So let's hit it up. Everyone would tell you that keep track of your goals and the progress you have made. That's how you know you are on the right track, and it also keeps you motivated, provided that you're doing good. For my journey to financial freedom, I'm doing it by penning down my finances in the 3 statements, just like how a business would do it. Financial statements are like a dashboard for a business. They tell us where the money is coming from, where it is going, how much they have, and where exactly it is. That is why it's a super helpful tool for businesses to make smart moves. And I believe that everyone can implement that in their personal life. So the first thing we need to understand about accounting is the 2 different methods used. The first one is the cash accounting method, and then the second one is the accrual accounting method. Let's first get to the cash accounting method. If you are new to the finance world, cash accounting is exactly what you would assume accounting to be like. In this type of accounting, you just record down all the expenses and income as it happens. So for an example, let's say you bought a yearly subscription of Netflix at $120. All you would need to do is record down an expense of $120 today. It really is that simple. Moving on, for cash accounting, you actually need 2 types of statements. The first one is the income statement, also known as the profit and loss statement. The second one is the balance sheet. I will let you know what these statements are and what they cover later on in the video. So cash accounting is actually good enough for you to track your personal finances. In fact, even most of the small businesses do it this way. However, if a business wants to grow rapidly, they would need to involve external investors. And for that, they would need to account in the accrual method. But you might ask, what's the purpose? Like, if cash accounting works, why do we need to use this fancy method? Well, there is a flaw with the cash accounting method. Instead of Netflix this time, let's take an example of a bigger expense. Assume that you paid your yearly rental upfront, and if the rental is $1,000 per month, you paid $12,000 in January. In cash accounting, you would account for this expense, $12,000, in January itself. So it will look like you had a really bad month, and for other months where there is no rental expense, it will look like you made a pretty high profit. However, you know that that's not the truth, and hence it makes it really hard for investors or any third party to understand your finance properly. This is especially true in big companies where there are so many things to account for, and you can't go around and telling everybody that, oh, this expense is for like a yearly rental or yada yada yada. This is exactly why somebody smart came up with this more complex type of accounting called the accrual accounting. In accrual accounting, you basically record down the expense as you consume it. So for the Netflix example again, you will split up the $120 over the period of 12 months and record it down separately as you consume the service each month. So it will be $10 every month, and this will give you a better picture of your profit and loss in a particular month. This is not just limited to expenses but also income. So let's say you switch sides with Netflix now. So you are Netflix and you will be collecting $120 for the whole year upfront. But you would also have to split it up over 12 months and record it down as an expense for each month as and when you have provided the service. Accrual accounting also accounts for payables, that is like a product or service that you have already consumed but are yet to pay for. The opposite would be receivables. For payables, let's take an example of credit card payments. In cash accounting, when you pay for a product or service through a credit card, you won't account for the expense when you actually purchase the product or service, but you will record it when you are paying the credit card companies. This might give you a false sense of profitability in a business. However, there's an issue with accrual accounting as well. Since you're not accounting for cash, it is not possible for you to know if you're running out of money in the short term. To solve this issue, accrual accounting uses a third statement, which is the cash flow statement, in addition to the other 2 used in cash accounting as well. That's basically it for the two methods of accounting. There are other things involved in accrual accounting, such as depreciation and amortization, but these are the things that are not relevant to us, and I would rather not confuse you guys with it. Okay, so with all that covered, let's look into the three basic financial statements and examine how they work together to give us a full picture of our financial health. Firstly, we'll cover the income statement, then the cash flow statement, and lastly, the most important one, the balance sheet. Income statement tells you how profitable you were over a given period, such as a month, a quarter, or a year. It tells you how much money you made, the revenue, how much you spent, the expenses, and whatever you are left with, the earnings. It is pretty basic stuff and very intuitive once you start doing it, so I won't be wasting much time in this topic. Moving on, the second one is the cash flow statement. The cash flow statement, like the name suggests, shows us the movement of cash over a period of time. It has three parts. Firstly, the cash flow from operating activities. Secondly, the cash flow from investing activities. And lastly, the cash flow from financing activities. Cash flow from operating activities shows you exactly how much money was generated by the core business of a company. So in your case, if your core business is your job, then it will show you exactly how much money you made at your job. And it will not give you anything other than that, like gains made by selling your house or any like stimulus check that you receive from the government. So this gives you a clearer picture of how the business is doing without any sugarcoating, and it removes all the outliers, if any. The cash flow from investing activities. This is exactly where all the cash movement comes in, which you use for buying investments, properties, or even equipment that might make your work life more efficient. Lastly, the cash flow from financing activities, which mainly includes any loan that you might take or repay. So that's about it for the cash flow statements. Now let's move on to the last part, which is the balance sheet. The balance sheet is where all your marks come to in the end and add up to give you your final grade, aka your net worth. How, you may ask? Well, it's very simple. It adds up all your cash, investments, and other receivables under assets, and all your payables and loans under liabilities. Then it's just a matter of simple subtraction, all your assets minus your liabilities, and voila, you have your net worth. So that's about it for today. I hope I was able to give you a crash course on accounting. Do not worry if you don't completely understand it yet. It does take practice to get a hang of it. Just know that you're on the right track. In the next episode, I will go through my personal financial statements for you guys to have a better look. And hopefully you can use this for your personal finance tracking as well. Like always, if you're interested, just subscribe and stay tuned. Until then, ciao.